So, for the balance sheet, please, it looks bulky at a glance, but you just have to take them items by item, and it will be very simple for you. Now, in the balance sheet, the items we take there mainly are the assets, liabilities, and capital. So please pay attention. In the balance sheet, you take your assets, liabilities, and capital. Okay. So here we don't bring expenses. If you bring any expense here, it means that expense is now an asset. And when we start the adjustment, you would appreciate when an expense can be an asset. Okay, good. Now, that being said, you remember our assets are fixed or current. They can be fixed asset or current asset. So in the balance sheet, we try to group the assets into fixed and current. You also remember liabilities, we have long-term liability and then current liability. So we are also going to do that same categorization here. Okay, good. But again, you are only bringing in your assets, your liabilities, and capital. Now, the arrangement is what sometimes confuses students. So take them one by one. You still have the title, balance sheet, as at. So unlike the trading and profit and loss account, which were having a title for the year ended, the balance sheet has as at. And the reason is because the balance sheet will cover all the assets, liabilities, and capital of the business since the time that they started business. Okay, but the profit and loss and the trading account, they end for the year ended because we only prepared for one financial year. So example, we can prepare trading account, profit and loss account for the year 2023. But if we are preparing balance sheet, it will not cover only the year 2023, it will cover all the years the business has been in existence. So that's the reason for the difference in the titles for the year ended and then asset. Thank you. So when you bring in the title now, the first thing you have to think about is your fixed assets, your fixed assets, fixed assets. Okay. So if you are here and you are not familiar with your fixed assets, you are going to struggle. And you know that your fixed assets are also classified into tangible and intangible. The tangibles are those that you can see, feel, and touch. The intangibles are those you cannot see, you cannot feel, you cannot touch. So examples of the tangible fixed assets are land, building, because you can see land, you can touch it. You can see a building, you can touch it. Fixtures and fittings, motor vehicles, plant and machines. I think last time we even listed all these things here. Let me see if they are here for us. Okay, I think it's the income and expenses that we listed. But in our discussion on the double entry, I think I did my best to take you through majority of the fixed assets. So I'm just repeating them. Land and building, fixtures and fittings, motor vehicles, those who are writing should write. Premises, okay, motor vehicles, plant and machines. You can identify these things, okay, when they drop in the question. Now, the intangible ones, those that you cannot see, feel, or touch, you remember are the goodwill, the copyright, and then investment in intangible items. Okay. So you bring your fixed asset first. Now, if you look at the right-hand side of the balance sheet, you see some amount columns. So we also keep 3 amount columns in the balance sheet. Now, for the fixed assets, when we do the adjustment, you would acknowledge that when you buy a fixed asset, it loses value as you continue to use it. Example, if you buy a Toyota car today, 10 years time, it is not going to be the same. The tires may be wearing off, the body may be rusting. So that's what we call depreciation. The asset is depreciating. So depreciation means the asset is losing value. And like the example I give, if you buy a car today, even next year, next 2 years, it's going to start depreciating. It will be rusting, the tires will be wearing off, even the painting will be changing and all that. Okay. So in the balance sheet, we acknowledge that as the depreciation. So normally we bring the cost of the assets, and then that depreciation will less it from the cost to get NBV. The NBV means or stands for net book value. So in order for you not to see it as something big, for example, you bought your phone last year at 1,500 cedis. So that will be the cost of that mobile phone, 1,500. You have used it for 3 years. So all other things being equal, the phone has lost value. The screen has cracked. What do you call it? The back is peeling off. In fact, so that, should I say, spoilage is what we call depreciation. So let's say you measure and you say, oh, my phone has depreciated by 200. Then when you less the 200 from the 1,005, which is the cost at which you bought it, the figure you get, which is 1,300, is the net book value. As simple as that. When we start the adjustment, you begin to appreciate more. So there are some questions you will not have this depreciation. So straight away, the cost becomes the net book value. Okay. But what is important is that begin with your fixed assets. Any question before I continue? Okay. I'm sure when we finish discussing the format and we solve an illustration, it will make sense. After the fixed assets, the next thing you present in your balance sheet is the current assets. The current assets. Okay. Now the current assets, you know them, my dear ones, because we have listed them before. Stock is one of them. Which stock? The closing stock. The next one is debtors. Debtors are people who owe the business. So it's a current asset. They are current asset because they don't really last longer compared to the fixed asset. The fixed assets last longer. So even if you are confused when you are working out something, you can use these questions to determine that this is a fixed asset and this is a current asset. Fixed assets last longer in the business, but current assets are not expected to last longer. So stock, for instance, if you have stock of goods, it is expected that you sell them. So you are not expecting that you keep your stock for 5 years, 10 years. No. Debtors, same. If people are owing you, you expect them to pay you on time. Okay. Prepaid expenses. When we say you have prepaid an expense, it simply means you have made payment, but you have not enjoyed that particular benefit. For example, if you give your landlord 1,000 cedis today to rent his room for 1 year, you have not enjoyed the room, but you have made the payment. So that rent has been prepaid and it's your money, it's your asset. Okay. The next one is accrued income. Accrued income means that the business is supposed to receive an income, but the business has not received it. It's simple. It is still your income, just that you have not received it. So it's an asset. Example, you make an investment. You go to the bank and you make an investment. And let's say for the year 2022, which is past, you were supposed to receive interest from the bank for your investment, let's say 1,000, but the bank has not paid it to you. You have to show it in your balance sheet that you have that interest on income which has not been received. Okay. Then the next one is your bank, money you have in your bank account, and the last one is your cash. So ladies and gentlemen, if you are appreciating, your current assets are stock, debtors, prepaid expenses, which can be rent prepaid, insurance prepaid, telephone bills prepaid, and the most common one is electricity prepaid. nowadays we prepay our electricity. We pay before we use the electricity. So that's a typical example of prepaid expense, prepaid electricity. Then your accrued income, which can also be one or two, your bank and cash. So they are just 1, 2, 3, 4, 5. And you have to keep these things in your beautiful brains for me. Okay. Now, looking at the arrangement, your current asset will be in the middle or the second column. So when you list them there, you put the total there as total current assets. So your balance sheet, you start with your fixed assets, you continue with your current assets. Any question? No question yet. Okay. After your current asset, the next thing is your current liabilities. Your current liabilities. And your current liabilities, they are also not plenty. Going straight ahead to them, you have your creditors. Creditors are people the business owe. So the suppliers that we owe. Okay. The next one is bank overdraft. This bank overdraft is the opposite of the bank you see here as a current asset. This bank is money you have in your bank account. Bank overdraft means that you have withdrawn more than what you have in your account. So your account is negative. And this is a type of, in fact, it's a type of a loan a bank gives to its customers, specifically current account customers. If you have 1,000 cedis in your account, the bank can allow you to withdraw 1,500. So the difference 500 becomes the overdraft. And that overdraft simply means that you now owe the bank. Okay, so it's a liability. The last two are also the opposite of prepaid expense and accrued income. So the opposite of prepaid expense is expenses accrued. Another word for accrual means owing. You are owing the thing. So the example I gave for the rent, in the first scenario, you paid the rent to your landlord before using the room. In the second scenario, which is expense owing or rent owing, it means you haven't paid for the rent, but you have used the room. Do you get the distinction?
Yes, please.
Okay. Now, the income prepaid also means that this time, unlike the current asset accrued income where you have not received the income, this time they have paid the income to you in advance. Now, let me use your school fees and then yourself and then your school. Then maybe you can understand this. If you are considering yourself as a business, you see sometimes you pay your school fees in advance. For instance, you are in first term, but your father has paid your fees for second term and third term. So to you, that money is a prepaid expense, prepaid school fees. If your parents have not paid, let's say you are in Form 2 first semester, and your parents have not paid for your fees for last semester, then that becomes expense owing. Okay, you haven't paid for the fees, so it is in arrears or is owing. So that is from your end or from your perspective. Now, if you look at the perspective of the school who is receiving the school fees, so to the school, the fees is an income. So now, if you pay your school fees in advance to the school, it is a liability because they have not taught you, but they have collected the fees. So just take your time and really analyze this prepaid expense and accrued income. And trust me, when we pick the adjustments, they will pop up there. So we'll look at them. But what I want you to appreciate is that when you are preparing your balance sheet, bring your fixed assets first, followed by current assets, followed by current liabilities. And normally we less the current liabilities from the fixed assets. So as you follow the format here, you will list your current liabilities at the first column. So creditors, bank overdraft, expenses owing, income prepaid, you list them at the first column. And then the total comes under the total current assets. And when you less, please pay attention because this is highly examinable. When you less current liabilities from current assets, what you get is called working capital. Working capital. So working capital is the difference between current assets and current liabilities, or working capital is current assets minus current liabilities. Okay, so when you get the working capital, you add it to the fixed assets. Okay, the fixed asset that you listed first, you add it to it, and then you get a final figure you call net total asset. So my dear student, let me make this skeleton clearer for you. In your balance sheet, you first list your fixed assets. Okay, so you first list your fixed assets, and then you come and look for your working capital. But your working capital is you bringing your current assets and then lessen your current liabilities. Is it making sense now? I want to believe yes. Okay, so that's the first section of the balance sheet. Fixed assets, go and look for your working capital, and working capital is current assets less current liabilities. Okay, any question? Still no question. Okay, so if you remember, I said you bring your assets and liabilities and capital into your balance sheet. We've brought our fixed assets and current assets. We've brought our current liabilities. So we are left with capital and long-term liabilities. And that is where the second section comes in. So the second section is only bringing your capital, okay, your capital, and then the long-term liability. Ladies and gentlemen, the only long-term liability you come across under the sole trader's final account is bank loan. Okay, so the capital, you bring your capital, but normally we add the net profit you have gotten from your profit and loss account. And then you remember the drawings, because if the owner withdraws something for personal use, we have to less it from his or her capital. Okay, so at the final session, you bring in the capital and then adjust these drawings and net profit. And then you add the long-term liability, which is the bank loan. And what you get is called capital employed, as simple as that. And that ends your balance sheet. Okay, so I'll give you some 2 minutes to think through and ask questions where you'd want to ask questions before we attempt the illustration we solved earlier to prepare the balance sheet. So I'm waiting for questions. Question time. Oh, you won't ask me a question. Okay, let me ask you a question. Please, the difference between current assets and current liabilities is called what? Yes, Jacinda.
Please, working capital.
Thank you very much. Thank you very much. That's working capital. The difference between current assets and current liabilities. Thank you very much. Now, another question. If you are preparing your balance sheet, what should you start with first? Based on our discussion, what should come in first when you are preparing your balance sheet? Yes, who's going to answer that? Nana Yao or Mame Ya or Kennedy? Mame Ya.
Fixed assets.
Your fixed asset. Thank you very much. Good. After your fixed asset, what comes next is your current assets. followed by your current liabilities, which you less to get the working capital, add to the fixed asset to get the net total assets. Thank you very much. So I believe we can solve the illustration now. So we are back to the illustration. Okay, so let me erase the trading and profit and loss. Please take note of our net profit. Our net profit was 3,170. Okay. So we'll use that in the balance sheets. Okay, so let me set up the balance sheet. Then we can make progress. Please, I encourage you to take this topic very serious. Do more of solving questions and practicing it, and you will thank me later. So balance sheet as at 31st December 2002. And as we have all agreed, you need to bring in your currency. So the currency is Naira. The currency is Naira. So let me put the Naira here. 1, 2, and 3. So the first thing you think about is your fixed assets. So my dear student, let's go through this question and fish out the fixed assets. So moving from top, we have stock, purchases, sales, rent, wages, telephone, premises. So you see the first fixed asset here is the premises. And I believe you all agree. And you'll find this asset at the debit side of the trial balance. So you put in your premises. So as we showed there, you show the cost, the depreciation and net book value, but this question has no depreciation. So we can avoid that heading cost, depreciation and net book value. Okay. So we put the premises, which is how much here? 9,000. We push it straight at the third column. Simply because this question has no depreciation. You don't see any depreciation in this question. So you don't have to worry yourself labeling the cost, depreciation and net book value. Okay. After the premises, the next one is the shop fittings. Shop fittings, which is 8,000. Okay, let's go through if we find another one. Debtors, no carriage, no bank, cash, capital. Okay, so you see that these are the only two fixed assets you have. So you just total them. 9 plus 8 is 17,000. You underline that one there beautifully like that. Now, another way of doing this is you can, if you still want to show the cost and the depreciation and the net book value, you can do so. But then when you show the cost of 9,000, you show that there's zero depreciation. So you put dash there, you put dash there, or you don't put anything there, and do same for the shop fittings. Okay, but like I told you, it's not really needed. So you can avoid them and go straight to, putting in your net book values straight away there. Now, when you finish with the fixed asset, the next one is the current assets. The current assets. And the current asset, you and I have just agreed that we have the following as the current asset: stock, which is the closing stock. So come to the question and pick your closing stock. So you write your stock and you put it at the middle column, the second column, 2,550. The next one per the format is debtors. Right, so you see, it's the format that we are just following to get the items. And just to give you a glance of it, so we have stock, debtors, prepaid expense, accrued income, bank, and cash. So let's go into the question. We have stock, And we also have debtors in this question, which is 1,500. So debtors, as you see in the question here, 1,500. Then the next one is prepaid expense. Now, if you check through this trial balance or question, you will not see anything like prepaid rent or prepaid insurance. There's no prepaid here. So we don't have it there. Again, we don't have any accrued income there. You don't see, unless maybe my eyes are deceiving me, but I don't see anything like accrued income here, anything like that. Okay. Normally, those things even come in the notes. Okay. They are not even in the trial balance. They come under the notes. So in this question, we don't have those things. So the next thing is the bank. And obviously we have bank here, which is 22,050. And then finally the cash, which is 1,150. And that's all for your current assets, right? So you total them here. This plus this plus this plus this. That gives you 7,200. So this is your total current assets. Is it not simple? It's very simple. But my dear, you need to learn the format so that you can follow it. I'll pause here. Any questions so far? Okay. I think we can hurry up. We have 4 minutes more. So let me hurry up and wrap up this. Okay, so let me move on and now bring in the current liabilities, because per the format, after bringing your current asset, the next thing is to list your current liabilities. And per the format, you all saw that the current liabilities are creditors, bank overdraft, expenses owing, and then income prepaid. If you check this question, what are the items you have? Remember, liabilities have credit balance, so they will be at the credit side. Sales is not a liability. Capital is not. Loan is a liability, but it's the long term, not the current. So the current one you have here is your creditors, as you see it here. So you pick your creditors, and there's no bank overdraft or anything. So in this case, you can push your creditors figure straight away under the total current asset, because that's the only current liability. So you less this from the total current assets, and what you get is the working capital. Working capital. So this working capital is the 7,250 minus 950. You get 6,300. So the 6,300 working capital, you add it to this fixed asset you had here, the 17,000 fixed asset. Okay, so working capital plus the fixed asset here, you get 23,300, and that is the net total assets as shown on the format. Okay, very simple, very, very simple. So after that, you are left with your capital and then long-term liabilities, which is under the section where we begin with the financed by. Then you bring in your capital. So how much capital do we have in this question? 11,130. And as per the format, you have to adjust your net profit and drawings. So you check the question for drawings. The net profit is what you have already calculated in your profit and loss account. So let's list the drawings. And then we also add the net profit. So the drawings is in the question, drawings is 1,000. And what did we get for the net profit? We took note of that. 3,170. So 3,170. So let's add that together. So 11,130 minus 1,000 plus 3,170. You have 13,300. Then you are left with the last one, which is the long-term liability. In this question, there is a long-term liability. Ekuye's hand is up, but I'm coming, which is the loan. The loan, which is 10,000 cedis. So you add the 10,000 cedis to it. And my dear, you would get 23,300. And that is equal to the net total assets. And that figure is called the capital employed. Okay, Ekuya, let me get your question, and then we can wrap up.
Please, I thought since you did calculations to get the net profit, you write the capital and less drawings in the second column before you write the total in the last column.
In this case, you
But
can
it doesn't matter.
Yes, it doesn't matter to put all of them at the third column when you get to the finance bar. Okay. Okay, so my dear student, I'll put these videos in your group. Please study it and go over. I'll also put